Something unusual is happening in India right now, and if you understand what it means, you're going to be ahead of 99% of investors watching gold. Because what's unfolding in Mumbai and Delhi over the past 3 weeks isn't just a local story. It's a warning signal that's about to ripple across global markets in ways most people aren't prepared for. Let me paint you a picture. It's early November 2025, and gold dealers across India are reporting something they haven't seen in years. The premium on physical gold, the amount buyers are willing to pay above the international spot price, just hit $78 per ounce in major cities. To put that in perspective, the normal premium in India runs between $5 and $15 per ounce. We're talking about a premium that's exploded by over 400% in less than a month. Now, you might be thinking, okay, so Indians are buying more gold. They always buy gold. What's the big deal? And you'd be right to ask that question. India has always been a massive gold consumer. But here's what makes this different, and here's why you need to pay attention. This isn't happening because of wedding season. This isn't happening because of Diwali. Those festivals already passed. This is happening because of something far more significant, and it's spreading to other countries faster than anyone anticipated. The premium spike started in the third week of October, right after the Indian government made a quiet announcement that most Western media completely ignored. They announced new restrictions on gold imports starting January 2026, citing concerns about the current account deficit. But here's what they didn't say publicly, what you had to read between the lines to understand. They're preparing for a scenario where physical gold becomes increasingly difficult to source internationally. And Indian buyers, some of the most sophisticated gold investors in the world, immediately understood what this meant. They started buying. Not just buying, panic buying. Jewelry stores in Mumbai reported lines out the door. Gold dealers in Delhi sold out their entire inventory within 48 hours. And here's the critical part. They couldn't restock fast enough because the global supply chain for physical gold is already stretched thinner than most people realize. Let me take you inside what's actually happening on the ground, because the numbers tell a story that should concern every investor holding paper assets. In the first week of November, India imported 89 tons of gold. That's not a typo. 89 tons in a single week. To give you context, their average weekly import is around 15 to 20 tons. They quintupled their normal intake, and it still wasn't enough to meet demand. Refineries in Switzerland, which supply a huge portion of India's gold, are running 24/7 operations and still can't keep up. I spoke with a contact at a major Swiss refinery last week, and he told me something that should make your ears perk up. He said, "We're seeing order volumes we haven't seen since 2020, but back then it was coming from everywhere. This time, it's concentrated. India, Middle East, and now we're getting massive orders from Southeast Asia." That last part, Southeast Asia, that's the spreading I'm talking about. Because what started in India 3 weeks ago is now showing up in Thailand, Vietnam, and Indonesia. Premiums in Bangkok jumped from $8 to $34 per ounce in just 10 days. In Ho Chi Minh City, dealers are reporting premiums of $41 per ounce, and they're struggling to source inventory. This is a contagion, but not the kind the media talks about. This is a physical gold contagion, where the realization that physical metal might become scarce is spreading from one market to another, creating a self-fulfilling prophecy. And here's what makes this particularly dangerous for the paper gold market. The vast majority of gold traded globally is paper gold. Futures contracts, ETFs, unallocated accounts. But when physical demand spikes like this, when premiums explode, it exposes the fundamental fragility of that paper system. Let me explain the mechanics of what's happening, because this is where it gets really interesting. The London Bullion Market Association, the LBMA, is the heart of the global gold market. Most gold trading happens there, and most of it is unallocated, meaning you don't own specific bars. You own a claim on gold that exists somewhere in a vault. The system works beautifully as long as everyone doesn't ask for physical delivery at the same time. But here's the problem. When premiums spike in physical markets like India and Southeast Asia, it creates an arbitrage opportunity. Traders can buy gold in London at spot price and sell it in Mumbai at spot plus $78. That's a massive profit margin. So what happens? Gold starts flowing out of London, out of New York, out of the COMEX warehouses, and into these high-premium markets. And we're already seeing it. COMEX registered gold inventories, that's the gold available for delivery, dropped by 340,000 ounces in the past 2 weeks. That might not sound like much, but it's happening at a time when we're also seeing record outflows from the LBMA. In October alone, 87 tons left LBMA vaults. Where did it go? A significant portion went to India and the Middle East. Now here's where this connects to something bigger, something that should concern anyone holding dollars or dollar-denominated assets. This physical gold rush in Asia isn't happening in a vacuum. It's happening against the backdrop of the most aggressive de-dollarization campaign we've seen in modern history. The BRICS nations, Brazil, Russia, India, China, South Africa, plus the new members, Saudi Arabia, UAE, Egypt, Ethiopia, and Iran. They've been systematically reducing their dollar exposure. But it's not just about selling treasury bonds, though they're doing that too. It's about building alternative systems for trade settlement and accumulating hard assets, primarily gold. China's central bank just reported its 18th consecutive month of gold purchases. They added 23 tons in October. Russia, despite sanctions, despite everything, added 15 tons. India's central bank, separate from the consumer buying frenzy, added 9 tons. And these are just the official numbers. Most analysts believe the actual accumulation is significantly higher because central banks don't have to report purchases immediately. But here's what's really fascinating, and this is where the story gets deeper. The premium spike in India isn't just about import restrictions or consumer demand. It's about a fundamental shift in how Asian markets are valuing gold relative to the West. In London and New York, gold is priced in dollars and traded primarily as a financial asset, a hedge, a portfolio diversifier. In Asia, gold is increasingly being priced as an alternative to the dollar itself, as a parallel currency, as the ultimate store of value in a world where fiat currencies are being debased at an accelerating rate. Think about what that means. When Indian buyers are willing to pay $78 over spot, they're not just saying they want gold. They're saying they don't trust the dollar price of gold. They're saying they believe the real value of gold is significantly higher than what the paper markets in the West are indicating. And they're willing to pay a premium to secure physical metal now, rather than risk not being able to get it later. This is a vote of no confidence in the paper gold system, and it's spreading. Because once this psychology takes hold in one market, once people see premiums spiking and inventory disappearing, it triggers the same response in neighboring markets. Fear of missing out, fear of being priced out, fear of not being able to access physical metal when you need it. Let me tell you about something that happened in 2020 that most people have forgotten, but that's incredibly relevant right now. In March and April of 2020, during the COVID panic, we saw a similar premium spike. Gold premiums in some markets hit $100 per ounce. Refineries shut down, transportation was disrupted, and suddenly, the paper price and the physical price diverged dramatically. But here's the difference between then and now. In 2020, it was a temporary supply chain disruption. Refineries reopened, transportation resumed, and premiums normalized within a few months. What's happening now isn't a temporary disruption. It's a structural shift, driven by policy decisions, geopolitical realignment, and a fundamental loss of confidence in the dollar-based financial system. The Indian import restrictions I mentioned earlier, they're not temporary. They're part of a broader strategy to reduce dependence on dollar-denominated commodity imports. And India isn't alone. We're seeing similar moves across Asia. Thailand is exploring gold-backed trade settlement with China. Malaysia is discussing gold-based payment systems for palm oil exports. Indonesia is considering gold reserves as partial backing for a new digital currency. This is a coordinated, strategic shift away from dollar dependence. And gold is at the center of it. And when you understand that context, the premium spike in India isn't just a market anomaly. It's a symptom of a much larger transformation in the global monetary system. Now let me connect this to something that should matter to you personally, especially if you're thinking about retirement, about preserving wealth, about protecting what you've built over decades of work. Because what's happening in India and Southeast Asia right now is a preview of what could happen in Western markets if confidence in the paper gold system erodes further. Imagine waking up one morning and discovering that the gold ETF you own, the shares you bought thinking you had exposure to gold. Imagine discovering that when you try to redeem those shares for physical metal, there's a 6-month waiting list. Or imagine discovering that the premium for physical gold in the US has jumped from $50 to $200 per ounce, and your ETF is still trading at spot price because it's just paper. This isn't hypothetical. This is exactly what happened in certain markets in 2020, and it's what's happening in Asia right now. The divergence between paper and physical is real, and it's growing. Quick aside here, and this is important if you're sitting on $100,000 or more in retirement accounts. I put together a free guide on how gold IRAs work, how you can get physical gold into your retirement account without triggering tax penalties. It's in the description below. It covers the mechanics, the custodians, the storage requirements, everything you need to know. Worth checking out if you're thinking about adding physical precious metals to your retirement strategy. Anyway, back to what's happening in these markets and where this is headed next, because the implications are significant. The premium spike we're seeing isn't going to stay contained to Asia. It can't. The gold market is global, and arbitrage opportunities like this don't last long before they start affecting prices everywhere. Here's what I'm watching closely over the next 30 to 60 days. First, COMEX inventory levels. If we continue seeing drawdowns at the current pace, we could hit critically low levels by year-end. When registered inventory gets below a certain threshold, it triggers concerns about the exchange's ability to make good on delivery obligations. That's when things get really interesting. And by interesting, I mean potentially chaotic. Second, I'm watching premiums in Europe. So far, European premiums have remained relatively stable, around $15 to $25 per ounce. But if Asian demand continues at this pace, and if more gold starts flowing east, we should start seeing European premiums rise. That would be the signal that this is truly going global. Third, and this is crucial, I'm watching the gold-silver ratio. Right now it's sitting around 84 to 1, meaning it takes 84 ounces of silver to buy 1 ounce of gold. Historically, when we see physical gold premiums spike, silver tends to follow with a lag of a few weeks. And when silver moves, it tends to move violently, because the silver market is much smaller and more volatile than gold. If we start seeing silver premiums spike in Asia the way gold premiums have, that's when you know this situation is accelerating beyond what most people anticipated. Because silver is the poor man's gold. It's what people buy when gold becomes too expensive or too scarce. And if both metals start showing significant premiums simultaneously, it indicates a broad-based flight to hard assets that transcends any single market or region. Let me give you some historical context that might help you understand where this could go. In 1980, during the last great precious metals bull market, there were periods where you literally couldn't buy physical gold or silver at any price in certain U.S. cities. Dealers were sold out, mints couldn't keep up with demand, and premiums went absolutely parabolic. I talked to a dealer who was in the business back then, and he told me stories about people lining up outside his shop at 5 a.m., waiting for him to open, desperate to buy whatever he had in stock. He said the premiums got so high that he was selling silver dollars for 3 times their melt value, and people were happy to pay it, because they were terrified of being priced out completely. Now, I'm not saying we're headed for that exact scenario. The market structure is different now. The supply chains are more sophisticated, and we have digital trading platforms that didn't exist in 1980. But the psychology, the fear of scarcity, the willingness to pay any premium to secure physical metal, that psychology is timeless. And we're seeing the early stages of it right now in Asia. Here's another historical parallel that's worth considering. In 2011, during the European debt crisis, we saw a similar pattern of premium spikes in certain markets. Greek citizens, facing capital controls and bank closures, started buying gold at massive premiums. Turkish citizens, dealing with lira devaluation, did the same. And in both cases, the premium spike was a leading indicator of broader financial instability. The premiums were telling you something that the official narrative wasn't. They were telling you that people on the ground, people with real money at risk, didn't trust the system. They didn't trust the banks, they didn't trust the currency, and they were willing to pay a significant premium for the security of physical gold. That's exactly what's happening in India right now, and it's spreading. The premiums are a signal, a warning that something fundamental is shifting in how people perceive risk and value. Now, let's talk about the supply side of this equation, because that's where things get really concerning. Global gold mine production has been essentially flat for the past 5 years, around 3,000 to 3,100 tons annually. We're not finding major new deposits, and the deposits we are finding are lower grade and more expensive to extract. Meanwhile, demand has been steadily increasing. Central bank buying hit a record in 2022, then broke that record in 2023, and we're on pace to break it again in 2025. Jewelry demand in Asia has remained strong despite higher prices. And now we're seeing this surge in investment demand driven by geopolitical concerns and currency debasement fears. You don't need to be an economist to understand what happens when supply is flat and demand is rising. Prices go up. But in the gold market, there's a twist. Because of the paper gold system, because of the leverage in the futures market, prices can be suppressed or managed in the short term, even when physical demand is strong. But that suppression can only last so long. Eventually, if physical demand continues to exceed supply, if premiums keep rising, if inventory keeps draining from the major vaults, something has to give. Either the paper price has to rise to reflect physical reality, or the paper system itself starts to break down. And we've seen glimpses of that breakdown. In 2020, we saw futures contracts trading at significant discounts to physical. We saw delivery delays. We saw some dealers refusing to sell at spot price, demanding premiums that made the futures price essentially meaningless. What's happening in India right now could be the early stage of a similar breakdown, but on a larger scale and driven by different factors. This isn't a temporary supply chain disruption. This is a structural shift in demand patterns driven by geopolitical realignment and monetary system transformation. Let me tell you what some of the smart money is doing right now, because it's instructive. I have contacts at several family offices, the kind of places that manage money for ultra-high net worth individuals, billionaires, people who have access to information and analysis that most investors never see. 3 of them have told me in the past month that they're increasing their physical gold allocations significantly. Not gold ETFs, not gold mining stocks, physical gold stored in private vaults outside the banking system. One of them told me explicitly, "We're treating this like 2007. We see the warning signs, we see the instability building, and we're positioning defensively." That's a pretty stark statement. 2007 was the year before the global financial crisis, the year when smart money started getting out of risky assets and into safe havens. And here we are, in late 2025, and some of the smartest money in the world is making similar moves. Now, I'm not saying we're on the verge of another 2008-style crisis. The circumstances are different. The risks are different. But what is similar is the sense that the system is more fragile than it appears, that the official narrative doesn't match the reality on the ground, and that physical hard assets are going to be crucial for wealth preservation in the years ahead. The premium spike in India is one data point. The BRICS de-dollarization campaign is another. The record central bank buying is another. The flat mine production is another. The draining COMEX inventories is another. Individually, each of these could be explained away. But when you look at them together, when you see the pattern, it paints a picture of a gold market that's fundamentally changing. And here's what most people miss. They look at the gold price. They see it's up 15% or 20% year to date, and they think, okay, gold is doing well. But they're missing the real story. The real story isn't the price in dollars. The real story is the divergence between paper and physical, the premium spike, the inventory drain, the structural shift in demand. Because if you own paper gold, if you own an ETF or a futures contract, and the physical market continues to tighten and premiums continue to rise, you might find yourself in a situation where your paper claim is worth significantly less than physical metal. You might find yourself unable to convert that paper into physical at any reasonable price. That's the risk that most investors aren't thinking about. They assume that gold is gold, that paper and physical are interchangeable. But as we're seeing in India right now, they're not. When push comes to shove, when people want physical metal, they're willing to pay massive premiums to get it, and paper claims become secondary. So what does this mean for you? What should you be doing with this information? Well, first, understand that we're in the early stages of what could be a significant repricing of physical gold relative to paper gold. The premium spike in India might normalize in the short term, or it might be the beginning of a sustained divergence. Second, if you're thinking about gold as part of your portfolio, think seriously about the difference between paper and physical. ETFs have their place. They're liquid. They're convenient. But they're not the same as owning physical metal that you can hold. That's stored outside the banking system. That's yours regardless of what happens to financial markets. Third, pay attention to what's happening in Asia. This is where the future of the gold market is being written right now. The West still dominates gold trading by volume, but Asia dominates physical demand. And increasingly, Asia is setting the real price through premiums and physical flows. And finally, understand that what's happening with gold is part of a much larger story about the transformation of the global monetary system. The dollar's dominance is being challenged in ways it hasn't been in 80 years. Alternative systems are being built, hard assets are being accumulated, and gold is at the center of all of it.
The premium spike in India isn't just about Indian buyers wanting gold.
It's about a fundamental shift in how a significant portion of the world values gold relative to fiat currencies. It's about preparation for a monetary system that looks very different from the one we've had since 1971. And if you understand that, if you see the bigger picture, then you understand why this matters. Because we're not just talking about gold prices going up or down. We're talking about a restructuring of the global financial system, and gold is going to play a central role in whatever comes next. The premiums are spiking, the inventory is draining, the smart money is positioning, and it's spreading fast. The question isn't whether this matters. The question is whether you're going to pay attention and act accordingly, or whether you're going to wait until the premiums hit your market and it's too late to position at reasonable prices.
This is your warning signal.
This is your early indicator. What you do with it is up to you.